We're not even thinking about raising rates. This is the most important statement of the FOMC press conference that was held on June 10th. Right after that press conference, the markets corrected probably about 1% on the S&P. And then on June 11th, we had another 6% correction on the S&P, which is a dramatic move for the S&P. This is the Not Even Wrong podcast. I'm Krim Delko. And first update on the fund. The fund is down 10% since June 10th, the last time we updated. That is driven by this macro move. We have lost about 5% in Tesla. We have lost 1% in Intel, 1% in Microsoft, 2% in our CRISPR basket, and about 1% in Raytheon. So it's pretty much in line with our positioning. And as the macro move indicates, we were just kind of washed down with the rest of the market. For the year, we're up 61%. The S&P is down 7%. We're outperforming by 68%. Let's get back to the FOMC. So Jerome Powell said two important things. One is we're not even thinking about raising rates. And the other is that we're evaluating controlling the yield curve. Those are two critical statements that relate directly to an episode we reported a while ago where we indicated that we believe that the Fed is in a pigeonhole now, that the Fed has to fight against the pressure of lower rates and a flattening of the curve. This is key because we believe the Fed doesn't want to flatten the curve to protect the financial system. That's the key, because a flattening curve means that financial institutions cannot really do business the way they're used to do business. And while you can adjust, we've seen that in Japan, we've seen that in Europe, or we're seeing that in Europe as we speak, it is very painful for the financial system. When I say financial system, I mean really everybody, from investment banks, commercial banks, funds, even index providers like MSCI. I mean, everybody lives off an upward sloping yield curve. It's the law of nature. This is like taking gravity away from nature and then, still running an airport and flying airplanes and doing things like that. It's just not possible to do business as usual. You can do business, you can reevaluate your business model, but having a flat curve, meaning flat zero, so it's not just flat, but zero across the board, and potentially having negative rates, that is something that it's just not in the cards right now. And Jerome Powell is adamant about the fact that he doesn't want that to happen. And I think the markets are testing him now. This is what happened on June 11th. The markets immediately, and this is how the markets work. Listen, we want this. You're telling us you don't want to do it. Well, let's see how far you can go. Let's see how far you can keep your word and you can keep your stance. We're going to test you. What is the market doing? Selling off indiscriminately. And who are the main drivers of the downturn? It's the financial stocks. JP Morgan down 10%, 4% on June 10th, 10% on June 11th, so about 14%. Just to give you an example, as a comparison, stocks like Amazon, Microsoft, stocks like that are actually up in the last 2 days if I take June 10th and June 11th. So relative to the financials, most other stocks, particularly tech stocks, have done pretty well. The industrials are, they're kind of like an attachment to the financials. If the financials don't do well, industrials don't do well because industrials need capital. And if the providers of capital are dead, then, how can industrials do well? So this is, in a nutshell, what this statement has produced. It's produced a sell-off in the financial markets driven by the financials. And the financials are selling off because of flattening curve, and the potential for negative rates is terrible for them. So right now, the Fed is being put on the spot because here's what's going to happen now. Listen, I'm the hedge fund, you're the Fed. I'm going to tell you, I'm going to start buying the 30-year bond. And you're telling me that you're not going to let that rate go down. So I keep buying. Because you know what? I'm going to sell that bond once the rate goes down to the pension fund, which is forced to buy it in a couple of years. This is front running This is what hedge funds do. They correct market prices. The market price right now of the 30-year bond is wrong. The Fed has made a statement that they're evaluating managing the yield curve, so they haven't committed to it. They should have said, if they wanted to avoid a sell-off as dramatic as this, they should have said, we're going to manage the yield curve, period. We're going to control the yield curve, and we're going to make it very difficult for anybody who is not accredited to buy the long-term bonds. Now, this goes against any kind of philosophy that Wall Street stands for. And of course, this is almost impossible for a Fed chairman to push through. But in the end, the long-term rates, which are still above 1%, they're a gift to the financial system. And the hedge fund community is taking advantage of this, trying to front run it, trying to bring the rate down because they believe the rate should be down. The rate should be, zero, or well, let's call it zero, because the question of negative rate is a whole other question that we don't want to go into right now. So as a summary, in the last 2 days, so since my last update, we had a sell-off in the market of, if you take the S&P, around 7%, if I include the post-FOMC meeting on June 10th plus the June 11th correction. So about 7% sell-off in the S&P. And with that, everything else has come down. I mean, this indiscriminately, even gold, I think gold was flat or slightly down on June 11th. So this is one of those, everything down the drain. What is up is bonds. So the bond prices are up. The 30-year treasury prices are up a lot, and the yield is down about 20 basis points, which, given the duration and the mathematics of bond markets, when you have very low rates, so let's say 1.6% on very low yields, about 1.6% on the 30-year, if you go from 1.6 to 1.4, the actual price goes up a lot. So the only thing that has gone up in price is the long-term bond, and correspondingly the yield has come down. And this is exactly what the Fed is trying to avoid right now. The Fed is trying to avoid the long-term yields to come down fast. Maybe they will come down over the next couple of years, but not right now. Right now, we want to have an upward sloping curve so the financial system, the financial markets, and the financial institutions can start adopting a new business model based on a flat yield curve. And this is what the hedge funds are now going to fight. They're going to ask the Fed for more commitment to control the yield curve. Or if the Fed wants to be wishy-washy and not clear about it, they're going to test the Fed exactly like they did on June 11th. Now, when I say the hedge funds, I don't mean there's some, master of the universe sitting somewhere in Manhattan pushing buttons. I just mean, as a metaphor, the aggressive price-setting community of Wall Street, the people that actually take risk and really do these kinds of trades where they take advantage of mispricings in the market, which tend to be typically hedge funds, but this could be also just a regular long-only bond fund that is saying, look, the 30 years are good, but I'm going to start buying, and if the Fed doesn't commit to controlling the curve, well, I'm just going to keep buying. Yeah, so this is the update for us. For Orange Capital Partners, I think we are in a situation right now that we are suffering, clearly. We are down 10% today, but I think overall the macro environment still fits our thesis. We're going to have very low rates, we're going to have a flat yield curve, and all the liquidity which is being pumped into the economy is going to go into valuable assets such as high growth stocks, maybe other things like exclusive real estate, maybe some things like gold, but particularly high growth stocks. And this is where our exposure is. Thank you.